As the vaccine optimism ramps up, two different market points are out there when it comes to the S&P 500. Goldman Sachs thinks it can rally to 3,600, factoring in economic prospects. But Societe Generale and Nomura in Japan are more bearish, saying the vaccine news is priced in already and the gap between the leading and lagging sectors just too wide. So the question is, who's right? Good time right now to bring in Wall Street's most closely followed economist, Allianz Chief Economic Advisor, Mohamed El-Erian. Mohamed, great to see you. Let's begin right there. So who's right? Is it Goldman or is it the Europeans with Soc Gen or over in Asia with Nomura? Who's right?
So actually, it's a really difficult question. And to understand why is because you are trying to get three things correct: the health outlook, the economic outlook, and whether people's behavior will change during this period of living with COVID. I think in the short term, we can expect the market momentum to continue. But for the longer term, we need these three things to resolve in our favor.
A lot is made, Mohamed, of this huge gap, this $4 trillion gap between the leading entities on the S&P, the big techs, and those that are lagging. Is that a warning sign for you, or is that just the new normal?
So I think it's understandable. What's so special about these names that have consistently outperformed? One is the world is coming to them. By going virtual, the world is going to their business. Second, they have massive cash on their balance sheet. So they are acting from a position of strength. And third, they generate positive cash flow. So these companies have become everything to everybody. You want to bet on the upside, that's where you should go. You want a downside protection, you're looking for strong balance sheet, that's where you can go. So I think the gap is really understandable. I think it depends ultimately on whether we get back to normality or some sort of normality quickly. If we do, then I would fade them. But I don't see reason to fade them at this point.
Well, the market, certainly we have the election in November, but before then we're talking about stimulus. We're talking about this stalemate in Congress. You're a big proponent of helping the economy along. What kind of damage is this doing as businesses who are desperate are continuing to have to wait?
I fear we're going to see the damage in the August numbers that are going to be available in the next few weeks. The July numbers basically gave us a very strong message. This is a resilient economy. So that is the good news. And we saw that again today with retail sales. We've seen it all week in terms of this is a resilient economy. But we don't want to press that too hard. I think we don't want short-term problems to become long-term problems. And this economy needs not just relief, but needs also Congress to start thinking about the longer term.
But you know what? We've just got the graphic on the screen, Mohamed. Retail sales were up more than expected when you take out the autos. Jobless claims down to 936,000, while still a very high number. It's under 1 million, which is very encouraging, and the first time that's happened in 21 weeks. Are we seeing also industrial productivity ticking up? Is this surprising you, or is the momentum starting to slowly come back?
So momentum was coming back and coming back in a very good way. I think that if you look at the leading indicators, all that data you cited is a little bit lagging, unfortunately. And in the past, those lags weren't that critical. But when the health situation changes in various states, these lags become important. If you look at the weekly economic indicator that the New York Fed publishes, if you look at the real high-frequency daily numbers, they suggest that certain states are not just leveling off, but slowing. And that's what we've got to be careful about. We cannot lose momentum at this point. We've got to maintain this positive momentum in the economy.
While you're here, I've got to ask you about gold. A meteoric rise of late. That's pretty interesting, but is that troubling to you?
Well, the troubling part is that it has collected people that are hedging against all sorts of things. And the reason why that's happening is because people are looking at treasuries and saying, not only do I not get paid very much, but my price risk is totally asymmetrical at this point. So gold has attracted those people trying to protect against economic Armageddon. It has also attracted people trying to protect against inflation. It has also attracted people trying to protect against reflation. And it has also attracted people trying to protect against currency debasement. When you have so many people protecting against competing things, it tells you that the system is distorted. And I think that this is yet another consequence of this massive Federal Reserve involvement in the pricing of market securities. We're seeing it all over, Ashley.
Yeah, it's you talk about normality with that factored in as well. Who knows when we'll get back to normal. But Mohamed, thank you so much for joining us today. A lot of people want to know what you have to say, and we appreciate you saying it right here on this network. Thank you very much.
My pleasure, and thank you.